Endowment Payout Process, Tutorial 1, Fiscal Year 2014 Endowment Payout Process Changes. There are several brief tutorials to help you understand the university's endowment payout process. This tutorial provides a high-level comparison of the old or pre-fiscal year 2014 processes with the new processes starting in September 2013, the beginning of fiscal year 2014. The Endowment Payout Project, aimed at simplifying Stanford's endowment payout process, began in late 2011 as a collaborative effort between the Office of the Vice President for Business Affairs, Financial Management Services, the Budget Office, Administrative Systems, and the Office of Development. The overarching goal of the project was to simplify the way that endowment payout occurs at the university. Prior to FY14, Stanford employed a method that took 100% of the funds in the endowment through a complicated year-end shortfall process, which we'll see in the next slide. The project team identified a different method that treats the vast majority of funds in the endowment in a very straightforward, simple way when it comes to the allocation of payout. This method eliminated the confusing shortfall process. There was also a disconnect between the movement of cash into and within the university, which follows a monthly cycle, and the accounting track, which was primarily a biannual process. The new process better aligns these cash movement and accounting tracks. Finally, the project team sought to identify a process that made it easier for campus fund holders to budget and forecast allocated payout. Let's start with the basic differences between the process before fiscal year 2014 and after. In the pre-FY14 process, endowment fund holders received an initial allocation of payout in November. This amount was determined by the number of shares held at the beginning of the fiscal year, multiplied by the annual payout per share approved by the Board of Trustees. In this example, we see $12,000 of anticipated payout for the year allocated to the income fund, or the spendable side of the fund, in November. It was not until the end of the fiscal year in August that payout was actually funded through a sale of shares. This was referred to as the shortfall process. In this method, a fund holder did not always know whether the amount allocated in November would be the final payout amount until shares were sold in August. For a small percentage of funds, the principal side of the fund did not have enough appreciation to generate full payout. Therefore, actual payout was less than what they had anticipated based on the November allocation. In the new method, the amount of annual payout is the same, but it is allocated monthly. Here we see $1,000 distributed to the income fund each month. Monthly payout is now determined by the number of shares held in the fund at the beginning of the month, multiplied by a monthly payout per share. Monthly payout per share is calculated by dividing the annual board-approved payout per share by 12. There is no sale of shares at the end of the year. However, there is a monthly impact to share value, which we'll discuss more in the next slide. The monthly amount distributed to the income fund represents actual payout, not an anticipated or budgeted amount. There is no year-end shortfall process that would result in payout being taken back out of the income fund. Note that although the payout is made monthly versus annually, there is no impact to spending flexibility. Fund holders may spend anticipated payout at any time during the fiscal year. Continuing with our example, here is a simple visual that illustrates how payout is funded in the old and new methods. In both scenarios, we start with an endowment fund valued at $300,000. It has 1,000 shares, and each share is worth $300 at the beginning of the year. Annual payout is $12,000. In this simple illustration, we do not consider new gifts or withdrawals, market value fluctuation, or the portion of payout that is funded by earnings, which in reality impact payout amount and share value. In the pre-FY14 scenario, The anticipated annual payout of $12,000 is allocated in November. During the year-end shortfall process, 40 shares are sold to cover the full $12,000 in payout. The number of shares in the fund decreases to 960. Payout does not cause a decline in the share value. There are now 960 shares worth $300 each, and $288,000 remains in the fund's principal. The number of shares decreases, but the share value remains constant. With the new method, the first monthly payout of $1,000 is made in September, and it results in a per share value decline of $1. Each month, the share value decreases by $1 per share to fund payout, and the fund's principal decreases by $1,000. By the end of the fiscal year, the value of the fund's principal is the same as in the pre-FY14 scenario, $288,000. In the new method, the number of shares remains constant, but the share value decreases. The monthly calculation of share value now takes into account that payout has been taken out of the fund, which results in the value declining. This is similar to what happens in a mutual fund when monthly dividends are paid and the net asset value of the fund goes down. The consistent number of shares in the new method addressed a problem with the old method. A fund's true value is now known on a monthly basis, and fund holders can more easily forecast endowment payout for future years since there is no sale of shares at year-end. In summary, with the introduction of the new endowment payout process in September 2013, the beginning of fiscal year 2014, there is no change to how the annual amount of payout is determined. It will still be based on an amount approved by the Board of Trustees. There is also no change to payout recipients' spending flexibility. The fundamental changes are payout timing. The new method is a monthly versus an annual process, and the source of payout funding, the decline in share value, much like a mutual fund paying dividends, versus the liquidation or sale of shares. As part of the endowment payout project, reports are updated to reflect the monthly payout along with reporting enhancements to allow fund holders visibility into total anticipated payout and remaining anticipated payout at any point during the year. This is the end of Tutorial 1, Endowment Payout Process Changes.